Welcome to PhillipCapital's Market Watch. I am Darren Chan, Senior Research Analyst from Phillip Securities Research, covering the REITs and property sector. Today, I will be discussing my outlook on S-REITs and which subsectors we prefer. The S-REITs index has fallen 10% year to date as of the filming of this video, with the bulk of the decline occurring after the FOMC meeting on 20th September, which indicated that interest rates are likely to remain higher for longer. Higher interest rates for longer imply elevated finance costs for an extended period of time, as well as lower asset valuations as cap rates expand. To tell how much compensation investors received for taking on risk by investing in REITs, we compare the dividend yield of REITs to the Singapore government 10-year bond yield. This is called the dividend yield spread. It has now narrowed to about 3% and is at minus 1.4 times standard deviations from the mean due to the recent spike in the Singapore 10-year bond yield to 3.4%. As a result, REITs are becoming less attractive for investors. Having said that, we see the dividend yield spread widening as we forecast Singapore's 10-year bond yield to fall to 3% and 2.8% at the end of 2023 and 2024, respectively, which would make REITs more appealing further into 2024. As REITs now trade at a price to NAV of 0.86 times, 2 times standard deviations below the mean of 1.03 times. This is even below the trough during COVID-19. We think this could be an attractive valuation level to consider adding S-REITs in anticipation for the eventual rate pause and decline. After the recent share price correction, S-REITs now trade at a forward dividend yield of approximately 6.4%, which is 0.5 times standard deviations above the mean of 6.1%. This means that when you invest in REITs now, you are, on average, getting a higher dividend yield compared to the 10-year historical average. This makes REITs an attractive option for investors seeking higher dividends or income streams. Next, we move on to our subsector preferences. We prefer the hospitality sector because we believe it has the biggest potential for DPU growth, as the increase in revenue can more than offset any rise in interest expense and operating costs in our view. August 2023 revenue per available room, or RevPAR for short, which is average daily room rates times occupancy, jumped 26.5% year-on-year, exceeding pre-COVID levels by 17%. Singapore's international visitor arrivals grew 45% year-on-year in September 23 to 1.13 million, but it is still 23% below pre-COVID September 2019. Visitor arrivals from mainland China grew almost 10 times year-on-year, but it is still only at 55% of pre-COVID levels. We think the recovery of international visitor arrivals to pre-COVID levels will help to further raise RevPAR, especially as China outbound travellers continues to recover. Additionally, the strong pipeline of MICE and entertainment events in Singapore bodes well for this sector. Lastly, we also prefer the retail subsector as tenant sales have been resilient and are higher at pre-COVID-19 levels. August 2023 retail sales index, excluding motor vehicles, grew 3.7% year-on-year and is now at 11.3% above August 2019 levels. The gradual increase in international visitor arrivals will help to underpin retail sales growth going forward. As a result, we believe the potential for positive rental reversions are still intact for both downtown and suburban malls. Downtown malls benefit the most from reopening as international visitor arrivals pick up, while suburban malls, which focuses on essential services, remain resilient in a downturn. To conclude, while S-REITs face challenges to grow DPU with higher borrowing costs and forex headwinds expected, from a valuation and forward dividend yield standpoint, we think this could be an opportune time for investors to add S-REITs for the eventual interest rate pause and decline. With that, I'd like to end this segment of PhillipCapital's Market Watch. Do remember to like the video, subscribe to us on YouTube, and follow us on our social media handles. Thanks for joining us and see you soon.